Hello everybody, thank you very much for joining this webinar. Very warm welcome. My name is Patrick Ryan. I'm a Director of Real Estate, Squire Patton Boggs, based here in London. In today's webinar, we're going to be talking about investment in the UK residential build-to-rent sector, or BTR for short. That is to say, large-scale, purpose-built, multi-unit buildings specially designed for rent rather than sale. Historically, compared to other jurisdictions, the US, Australia and most continental countries, the proportion of residential properties for rent in the UK has been very low, but that has markedly changed over the last 10 to 15 years, with consistent and at times rapid growth in the BTR sector. And that's what we're going to be talking about today. This is going to be a joint presentation with international real estate consultancy Knight Frank. And just to go over what we're going to cover, I'm going to give a very brief overview of the UK real estate market. That's going to be followed by Oliver Knight, a partner in the research team at Knight Frank, who will give an overview of the current trends in shaping the BTR landscape, as well as covering a few of the tailwinds which are actually driving the market. That's going to be followed by a very high-level legal guidance presentation from myself and my colleague Mark Barker, for people who know next to nothing about real estate law and practice. And then Charlie Giltz, a senior surveyor at the residential investment team at Knight Frank, who's then going to take us through a few actual BTR deals that he's come across, and that'll finish us off. So jumping straight into it, UK real estate market. Like markets around the world, it had a very difficult period, 2021, 22 and 23. Everybody knows the reasons: inflationary pressures, supply issues, basically arising from COVID and the Ukraine war. Some UK homegrown issues as well, which need to be mentioned. The effects of Brexit, of course, and then a failed government financial budget in September 2002, which caused a lot of financial turmoil. However, we think those issues are largely now behind us, and the fact remains that for most foreign investors, UK real estate remains a safe asset class, a go-to destination for investment. The election of a new Labor government this year in July, big parliamentary majority and an economic growth-focused agenda has also generated optimism, in particular because one of its prime objectives, the new government, is to implement policies to really attack the decades-old chronic UK housing shortage. As I said, the UK real estate sector did go through tough times 2021 to 2023, but as a matter of fact, the BTR sector did somewhat buck the trend. Oliver's going to go into a bit more detail about that, but in terms of rental performance and returns, it held up pretty well. And even in those years, it essentially continued a growth trajectory, which started from about 15 years ago. From what it was then, which was a pretty small sub-niche sector, to what it is now, a mainstream growing sector in its own right. You know, we've got BTR schemes, both built and established and under construction in all the big cities in the UK and most town centres as well. Why the growth? Well, certain fundamentals really. As I mentioned, UK historically very underweight in terms of the amount of rented accommodation. That was bound to change. The housing shortages that I've mentioned, leading to ever-increasing costs to buy one's own home, and that's increased the appeal of the flexibility that renting offers, and various other factors. And probably that's a good time to hand over to Oliver, who's going to take us into more detail about the BTR sector.
Thanks, Patrick. If we can move on to the first slide, I'm going to start by taking a look at some of the broad themes in the investment market here in the UK. And really just to build on something that Patrick touched on in his introduction, the build-to-rent market in the UK has really over the last couple of years bucked that broader trend that we've seen across commercial real estate markets, which have been quite impacted by those macroeconomic events which have taken place. In terms of what that looks like, well, we've tracked, and we can see on this chart, around £34 billion worth of investment, which has been spent either acquiring or funding build-to-rent assets since 2016. In fact, the last 4 years, we've seen consecutive record years for investment into the UK build-to-rent build-to-rent market, culminating, as you can see, in that 4.6 billion that we saw spent last year. And that growth, as I said, has come despite the challenges in the wider macroeconomic backdrop, both in the UK and globally. So high inflation, spike in debt costs, build cost inflation, to name just a few. In terms of what's happened this year, well, so far the data really suggesting that momentum has continued. We've tracked £3.2 billion, which has been spent so far in 2024, which, as you can see, is slightly ahead of where we were at this point in 2023. Now, all of that paints a fairly positive picture of the build-to-rent market in the UK. And as Patrick noted, undoubtedly there is still some very favourable sentiment towards the sector as a whole, and it's one which is underpinned by some pretty solid fundamentals. That said, it is worth digging a bit deeper into these investment numbers to really understand who and what is driving the market. So if we can move to the next slide. If we start with the who, well, the numbers on this slide just give a slightly more detailed breakdown as to where the money is coming from into the UK. And really one of the key themes here revolves around the diversity of capital coming into the market, which helps build the case as to why the build-to-rent sector in the UK has been so resilient in terms of investment in recent years. So since 2020, for example, a fifth of investment coming into the market has been from new entrants. So that's partly more established multifamily investors from places like continental Europe and North America, looking to gain a foothold in the UK. But what we've also seen is big pivots from investors who've traditionally been focused on other asset classes and who are looking to diversify income streams. Linked to that, more than half of investment that we've seen over that time has come from overseas. Traditionally, as I said, that's been led by North America, to a slightly lesser extent Europe. But what we're also seeing is a pickup, certainly more recently, in inflows coming from Asia Pacific as well. And then finally, there has been a shift in the type of capital being invested. So over the years, it averages out as a pretty even split between private equity and pension fund money as the primary types of capital investing in UK build-to-rent. But what we've seen this year is a much bigger proportion of some of that private equity investment in the market, really just reflecting the need for more risk-averse pension fund capital to hold back a bit in a challenging market. Next slide, please. The other big shift that we've seen, which has been supportive of those strong investment volumes, has been a move towards different subsectors within the broader build-to-rent umbrella. So we've seen a huge amount of capital targeting the single-family housing market, for example, so houses for rent, but also a slight uptick in co-living transactions taking place as well. But to focus on single family, that accounted for about 40% of total investment last year. It's accounted for the same again in 2024. And really for investors, this is about targeting as broad a demand pool as possible. So about 60% of private renters in the UK already live in houses, 50% of them already live in suburban houses. So this move to investing in houses, a natural kind of progression from the market. But overall, when we're talking about investment volumes, that jump that we've seen in single family investment, a little bit in co-living, really just helping to mask what has been a slight drop in investment and funding for traditional multifamily apartment-led schemes. Next slide, please. So if we zoom out a little bit to look at some of the operational drivers for the sector, really the big trend here for the rental market in the UK is that it continues to be very tight. That's really driven by a structural imbalance that we see between supply and demand in the UK. So this chart that you can see on the screen now tracks renting listings data from one of the major portals, and you can really just see that significant drop-off that we've seen in terms of the available supply of rental properties over the last few years. To put some context around it, back in 2017, we were averaging around 260,000 unique rental listings every month. Last quarter, that figure was around 150,000, so huge drop-off in terms of available supply. In terms of why we've seen that, well, it's partly a function of the fact that we're seeing a lot less churn in the rental market. So we're seeing tenants stay put in existing properties for a lot longer than they have done before. But it also reflects this shift that we've seen in rhetoric towards private individual buy-to-let landlords over that time from government, and the subsequent changes we've seen to tax and regulation that have been introduced, which have led to some of those individual private buy-to-let landlords exiting the market. Now, if you flip that back and you think about what that's meant from a build-to-rent perspective, really the net result has been pretty high occupancy in existing schemes, and really, really strong lease up in new ones as well. Next slide, please. And the reality is that pressure on supply in the private rented sector is something that we expect will continue. There is more regulation coming from government on the horizon. We've got things like the Renters' Rights Bill, which aims to provide more rights and protections for renters. But we're also expecting to see the proposed introduction of minimum energy efficiency standards within the private rented sector by 2030. So currently, about 60% of private rented stock in England won't be compliant under those new regulations. Now, that means that those landlords who aren't compliant will be either forced to invest to increase their EPC rating, or they'll no longer be able to let their home. Now, we think that actually one result of that is that we're going to see a further reduction in the volume of private landlords in the market, a reduction in the volume of homes being available to let. That's really just going to exacerbate that supply-demand imbalance that we're seeing already. Now, ultimately, that also enhances the opportunity for build to rent, and it pushes forward the professionalisation of the sector, which is a key selling point from an institutional perspective. Next slide, please. But that imbalance, or one result of that imbalance we've seen between supply and demand in the private rented sector, has been that it's put pretty strong upwards pressure on rents over the last couple of years. So we track rental growth within build to rent specific properties, and according to our build to rent rental index, annual rents, or asking rents outside of London, rose by about 4% over the year to May 2024. You'll note from the chart that is down quite considerably from those double-digit or record highs we were seeing in 2023. But what we're seeing at the moment in the rental market when it comes to rental growth is really a return to more sustainable levels of performance following those recent double-digit increases that we saw coming out of the pandemic. Another point to note, and you'll be able to see it on the chart here, is that the year-on-year build to rent rental growth has actually just ticked below year-on-year growth in earnings across the UK, and really we see going forward rental growth is going to be driven in the main by expectations of where earnings growth is going. And our latest rental market forecast, which we published earlier this year, really following that pattern. So that relationship between rents and earnings, a really strong one historically, and one that is just kind of recalibrating at the moment. Next slide, please. If we turn now to supply, so the volume of build to rent homes, as Patrick mentioned in his introduction, has grown dramatically in recent years. There are currently just over 120,000 complete build to rent homes across the UK. There's a further 160,000 at some stage of the planning process, either under construction or with full permission granted. That strong pipeline means that what we're seeing is that build to rent homes are making up a far greater segment of overall housing delivery across the UK. So already build to rent has climbed from less than 1% of net additional dwellings being built a decade ago to around a tenth so far this year. The Labour government wants the UK to deliver 300,000 homes per annum, and we really see build to rent having the potential to account for a sizable proportion of that, especially when we look at the pipeline as it stands at the moment. Next slide, please. But despite that growth, operational build to rent supplies, those 122,000 completed units, accounts for just a fraction of the total number of private renters across the UK. So those 122,000 units are basically about 2% of the 5.7 million privately renting households that currently are across the country. Even when you include the pipeline of units that are under construction, that figure only increases to about 3.1%. Now, in terms of what the growth potential of the sector looks like, if we compare with more mature multifamily markets abroad, in the Netherlands, in Germany, in the US, for example. We also look at the more mature student sector here in the UK. And it means that we estimate that build to rent at full maturity has the potential to account for between 30 and 35% of the private rented market. In terms of what that means and some context around that figure, it is effectively, it means that 122,000 complete units that we have currently would need to rise to 1.7 million build to rent homes based on today's population figures. So, the key takeaway here is that we are very much at the start of this journey. We still see there being potential for a kind of huge opportunity for scale in pretty much all locations. Patrick, at this point, I'll hand back to you.
Thanks very much, Oliver. We're going to switch to legal now, and I'll bring in my colleague Mark Barker, and we're going to outline some of the key issues an overseas incoming investor might find useful when considering acquiring real estate in the UK. As I said before, this is pretty high level for somebody who's not familiar with the way it works over here at all. We're just going to briefly touch on the legal interests one can acquire in real estate, registration of land interests and any restrictions on foreign ownership. There'll be a bit about transparency and publicity issues, a few practical issues in relation to actually finding a property, and again, some hints in relation to how the transaction may go at the end. And then at the end, a brief touch on taxation issues. Just to mention here, we're confining our comments to land in England and Wales. As some of you will know, the land system in Scotland is very different, and we're staying away from that today. So jumping straight into it, legal interests in the UK, what can one acquire? Well, basically two ways: a freehold, which is equivalent to absolute ownership, or a leasehold, which gives exclusive possession as if you were the absolute owner, but for a limited period. I say limited period, but note in the UK, especially in the investment world, leases are often very long. So leases of 100 years, 250 years, even 999 years are very common. And provided the rent is either nil or only nominal, those interests are equivalent freeholds. Just to mention the statutory system of common hold, it's a sort of special freehold ownership specially designed for flats and apartments as an alternative to leaseholds. In the UK, for technical reasons, a traditional freehold interest in part of a building is inherently flawed and not generally accepted in the market. So common hold was introduced as a sort of third way to deal with that problem. But it's been around for over a decade, but it really just hasn't ever caught on. And so we're really back to the two traditional methods I've mentioned, freehold or long leasehold. And at this point, if I could bring in my colleague Mark Barker. And Mark, if you could talk a bit about how BTR differs from the traditional model of home ownership.
Okay, so you alluded to this in your intro, Pat, in terms of BTR sees a purpose-built multi-unit building developed solely for the rental market with a single investor as landlord. So there's no private sales to owner-occupiers and no sales to individual buy-to-let landlords. And by having a single investor of a building with multiple units, it enables investment in residential property at scale, which can only help enhance yields. There are a significant number of UK and overseas investors active in the UK BTR market, names such as Greystar, AIG and Granger. Next slide, please. So what does a typical BTR development scheme structure look like? So the freehold will be owned by the BTR investor. That investor will grant residential tenancies to its tenants, so either private individuals or in some cases a registered provider of social housing. Commonly, we will see BTR schemes comprise some ground floor commercial space, so that space will be let to commercial tenants. And very commonly, we see investors in BTR both purchase and develop their opportunities through a special purpose vehicle, an SPV. And that has the benefit of both ring fencing liabilities in relation to the purchase and the development process, and also helps to facilitate a tax efficient exit. In terms of residential tenancies, UK legislation does give residential tenants some quite extensive rights, depending on what type of tenancies they are granted. Those rights can include the right to acquire the freehold of their building, the right to extend their lease or to manage their building. And so from an investment and control perspective, it's very important for the investor to make sure they get it right at the outset in terms of the tenancies they are granting to their tenants to ensure that those rights are automatically excluded. In terms of management, we often see investors work with specialist BTR managers in terms of the day-to-day operation and the letting of their schemes. And that has a number of benefits, not least of which is to promote a positive renter experience and also to help mitigate voids.
Thanks, Mark. And the legal registration requirements, perhaps if you could just run quickly through some of those issues.
Sure. So any purchase of property in the UK will need to be registered at the Land Registry to reflect the change of ownership. The Land Registry is a central government register in the UK, and each land interest in property, whether freehold or leasehold, will have its own unique title and title number. And each title is divided into three sections known as registers. The first of those is the property register. That identifies the property by reference to a plan and also details the rights, if any, which benefit the property over adjoining land. There is then the proprietorship register that identifies the owner and details of that owner's powers to deal with the land, such as instances where there is a mortgage, for example. Just to mention here that recent UK legislation has introduced the requirement for overseas investors who use a UK company to hold land to register the identity of the overseas investor who sort of sits behind that UK entity. And we'll touch on that in a bit more detail shortly. Sorry, Pat, just go back one more. There's also the charges register. Just in terms of that register, that just identifies the matters to which the property is subject. Things like rights of way, which affect the property, things like restrictive covenants, which may impact on use or development. And then finally, just in terms of the Land Registry, just to make it clear that it is a public register. So in terms of confidentiality, it is available for all to see, and therefore there is complete transparency around land ownership in the UK. So just in terms of that transparency I referred to in terms of the beneficial ownership, investors, overseas investors being, in terms of the ownership being transparent. So in 2022, there was a piece of legislation that was brought into force, the Economic Crime Transparency and Enforcement Act, which was fast-tracked through on the back of the Ukraine-Russia conflict. And its purpose was to crack down on foreign criminals laundering money through UK real estate. So there is now the requirement that an overseas investor who purchases UK property to register beneficial ownership on the Register of Overseas Entities that was brought in through the 2022 Act. And the Act is, or the register is given real teeth in terms of how that sort of plays through by virtue of the fact that an overseas investor would be unable to register its purchase at the Land Registry until the registration on the Overseas Entities Register is completed, and similarly would be unable to deal with that property, whether by way of sale, grant of lease or charge, until again that registration has been completed.
Mark, you've mentioned about the Economic Crime Act and the Register of Overseas Entities, which highlights the emphasis on transparency around beneficial ownership of UK property these days. Just to mention, there are similar requirements which apply where foreign investors create a UK company for the purpose of acquiring real estate. For all UK companies, there is a requirement to register people with significant control. So really, essentially, whichever route is taken, whether a foreign investor acquires real estate direct or uses a corporate vehicle to do so, there will be a public record within the UK of beneficial ownership with which anybody can search. It's necessary, therefore, to manage expectations in relation to what foreign investors might expect to be treated as confidential information. Just heading back to you, Mark, on the transaction. Perhaps let's have a bit of exploration about that.
Okay, thanks, Pat. So you found your property. So really the sort of first stage is then to agree a set of heads of terms with the seller of that site. That's usually with input from agents and lawyers to make sure heads of terms cover all the bits and pieces, all the issues that we expect and need to be covered off. We'll then move into a due diligence phase, and that comprises a number of elements. Firstly, carry out a title review, and that has a number of different purposes, one of which is to identify any issues which may impact or use or development. Also to check that the seller has power to sell the land and any sort of restrictions that may sit around that. We'll then carry out searches of a number of public records, which can give information on a number of matters ranging from planning and building control through to compulsory purchase. We will raise a number of inquiries with the seller's lawyers, and the purpose of that is to elicit as much information from the seller in respect to the property as possible based on its ownership of the site. And the whole rationale behind the due diligence process is to identify any material issues that impact on the property, particularly those that go to value, and in some cases what's discovered through the DD process may result in the purchase price being revisited, or in some cases, or worst case scenario, with the buyer deciding not to proceed with the transaction at all. I would just mention here title insurance. So I'm aware that in some jurisdictions, particularly the US, title insurance is used much more widely to cover just a general sort of level of risk across real estate purchase and investment. In the UK, the focus is very much more on the due diligence process, having a very thorough due diligence exercise carried out. And title insurance, indemnity insurance, is only really used in situations where, having identified a risk as part of that due diligence process, that risk cannot otherwise be satisfactorily mitigated or covered off. So in parallel with due diligence, we'll run the negotiation agreement of the transaction documents, which will then lead us through to financial close. And then the final piece of the jigsaw is the compliance stage, which picks up the land registry registration, any registration required on the Register of Overseas Entities, and any sort of registration required at UK's Companies House. Okay,
just turning to taxes, a brief look at those issues. Obviously, the UK tax regime, like most other Western countries, is complex, and detailed advice should always be taken. But just at a basic level, the UK taxes both income and capital profits generated from transactions in real estate, whether or not the person realising the property is resident for tax purposes in the UK. The types and rates of tax will depend, but are likely to include corporation tax, that is company tax, income tax, and capital gains tax. There may be reliefs. There are pros and cons of acquiring interest directly or via a special purpose holding vehicle, but which is best will always depend on the specific investor's tax position. Just moving on to mention a few other taxes. Stamp duty land tax, charged on the purchase price of an existing property interest on acquisition. It is charged at scaled rates, which for the purpose of a BTR property with 6 or more units is currently at 5%. SDLT is also generally payable on any rents payable under any lease interest which is acquired. But for the long leases that we're talking about here, such rents, as I mentioned before, will either be nil or nominal only, and so not give rise to any significant SDLT charge. Next, value-added tax, 20%, can arise on property transactions if the owner has, what we say over here, elected to charge VAT on the land. but normally such VAT charge can be recovered by the investor in its credit arrangements with the Inland Revenue, and so should not be a permanent cash cost to the transaction. Just to mention also, particular structuring is required when acquiring a development site on which a BTR development is to be constructed, basically to ensure that VAT, which would be payable to the contractor and other people involved in the construction, can be recovered as well. But that sort of structuring is very common, not normally problematic, straightforward, and is not usually an issue going forwards. So, having done that legal bit, if we could hand over now to Charlie. Charlie, if you could possibly talk about a few real-life BTR transactions you've come across, that'd be great.
Thanks, Patrick. Yeah, absolutely. I'm happy to talk you through a few significant deals that have happened in our space. So yeah, first page, both of these deals are both operational deals. So by operational, we mean they're up and built, tenants are living in them, and they're generating income streams. So I think the Lark on the left is a good example to start with. This is a typical multifamily housing building, so a build-to-rent asset that we traded at the back end of last year, sourcing a new entrant from the US. So this building's luxury build-to-rent scheme situated on a wider £15 billion master plan in the Nine Elms and Battersea area. So the US Embassy and other landmarks like Battersea Power Station on there. So yeah, much wider regeneration play. And then Project Green Bay on the right, similar, just building on Ollie mentioning single family housing, so a diversification within the tenure of build to rent, so rental homes. So this is something that was traded to Citra Living, who are a subsidiary of Lloyds Bank, so a FTSE 100 company, so underlying and demonstrating that institutional demand and appetite for build to rent. Just go to the next page, please. Got two more examples. So both of these deals are forward funding deals. So by forward funding, it's where the investor essentially funds the development through a series of payments through to the developer, and then inherits the building once it's up and built. So C2 New Bailey on the left is a recent deal, funded forward funding in Manchester. So again, typical multifamily building of 196 units. This was one of very few forward funding deals to happen in the space last year. For a lot of development deals have been slightly more creative funding structures, but this was one of the few typical forward funding deals. I think if you look at £55 million, so a slightly smaller lot size, which obviously had increased liquidity in the space compared to the larger ticket sizes. And then Yard House, finally, again, a good example of further diversification within build to rent. This is a forward fund for a co-living development in London. And this is we sourced CDL, who are a new entrant to the co-living space from Singapore. So again, underlining that institutional, international demand, and then further diversification within the space. CDL already own and have funded a number of build to rent developments. They've got big exposure in the student space. So this was sort of further evolution of their strategy into the UK living sector.
Brilliant. Thank you very much, Charlie. Well, we're right on about 35, 40 minutes, so that's ideal timing. A really short presentation about BTR, and as is apparent from what we've said, this is really the place to be for incoming investors, hence this webinar. Hope everybody who's joined us found that useful. If there's any query or interest or discussion of any sort, just contact any of our speakers today. There are our details on the last slide, and we'd be very, very happy to help you. That's all for today. Thank you very much for joining.